Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the show where you can have your property related questions answered by our team of experts. And joining me today is Lucy Waters, Managing Director of Aria Finance. Welcome, Lucy.
Hi, Stephen.
Good to see you. And Glenn Jacobs, Director of Next Home London Estate Agents. Welcome to you, Glenn.
Thanks for having me, Stephen.
Right, Lucy, you're going first and your question is this. Are the banks part of the housing crisis that we're experiencing at the moment or part of the solution? i.e., are lenders becoming too risk averse?
I think we went through a huge transformation in the market post global financial crisis. So that was, I would say, the biggest adjustment that the mortgage market saw. Arguably, and it's always popular for people to dislike banks and to suggest that banks are overcautious and they should lend more. But I actually am of the belief that the change in regulation around affordability that we saw post-financial crisis was a really positive one, because we were in a low interest rate environment for a long, long time. And then we've had the recent shock. I say recent, it's not that recent anymore, is it? It still feels recent. But and that increase in interest rates, if everybody was tested on affordability on low interest rates, nobody would have been able to withstand that. We've obviously had inflation run away as well. So people's cost of living has increased, albeit there's been some wage growth as well to try and keep up with that. I think that the banks have a genuine desire to lend. I don't think it's their business to lend. If they don't lend money, they don't earn money. There is a big, I suppose, restriction in a way, which comes from the regulator in how they do it and to what customers they can lend to. So whilst it may appear that the banks are being difficult, they have to adhere to the regulatory landscape to ensure that the loans are affordable to people and that they're assessing them properly. However, there's always an element of the market where it goes too far the other way. And I think that's where less of a pragmatic approach is taken, and banks try to cater for the majority, and therefore anything around the edges, it's easier for them to not try and push the envelope to, because the risk isn't worth the reward for the number of customers that it catches.
Lucy, Glenn and I were talking off camera about something that happened. 2008, we had the crash. Yep. And apart from the property industry, one of the industries that suffered greatly under that crash was the car industry, the motor industry. However, 2013 to 2016, they experienced the best boom they've ever had. And why was that? Because the financial restrictions came off HP agreements, no deposits became prevalent, 0% finance became quite regular, and generally the whole financial field relaxed their view of lending, and the industry boomed. Don't we need that in the property market?
So on the flip side of that, the banks have suffered serious fines and losses, and
only because they were paying out big commissions to people who shouldn't have.
Yeah, but it's an example of where the market gets carried away. So there's probably a middle ground, Stephen. And I think, we had the extreme post-financial crisis, as I mentioned, and then perhaps we went to the other extreme. There has been talk of lifting some of the restrictions, and I think that that's something that is on the FCA agenda. The reality is low deposit mortgage lending is always going to be seen as higher risk. So there are less banks and lenders in that space than your 25% deposit lenders.
But when we had those low deposits and low interest rates, the fallout rate, the arrears rate didn't go particularly high. It wasn't our fault that that crash came, was it? It was the American markets bundling up these portfolios of poor property lending.
I think the reason why we didn't crash is because we were in an artificial capital growth environment because of the availability of debt. People were able to lived beyond their means, and property prices went up and that paid for it. So people could refinance, they had perceived equity in their homes, but it was growing at a rate which was unsustainable, and that creates a bubble. So again, I come back to, it's not one or the other. I think house price growth is a fundamental part of the UK property market, but what we've seen over the years is sort of big sort of spikes over a period of time, and then it might plateau and even go back the other way. And that's usually driven by either big events or mini events. And it feels like recently we've hit a number of mini events, which has taken, I mean, you'll probably know more on the house price growth situation than me, but I feel that in a market where house prices are potentially retracting rather than growing, for people to leverage high and be stretched on their affordability is a really risky place for them to be, because if something happens, there's not really many ways out. And I think that is what the market is trying to protect, albeit, do I think we can do more? Always. I'm just not sure that it's an entirely bank-led problem.
I think the difference between then and now, though, is everything else is so much more expensive. I think you've got solicitors now. Solicitors' invoices are skyrocketed. You've got stamp duty now that's more than ever. Rents are so much more money now. So you've got first-time buyers that are paying $2,500 on rent that are now being knocked back for $2,500 on a mortgage. It's kind of it's a real tough situation to see which way to pivot to. Yeah, thankfully I'm not trying to work it out.
So just to try and answer our viewer's question, are the banks the solution or the cause?
I don't think they're either, actually.
No,
I don't think they're either. I think they can contribute to the solution.
We'll have to blame it on the government then, shall we?
Yeah, I think they can contribute to the solution. I don't think that they can do it entirely on their own. I think there's a lot of other factors at play for them to be able to make a big impact.
Okay, jolly good. Thank you for that, Lucy. Glenn. Well, hope you can answer this one. Where do the experts think the market is heading over the next 12 months, and is now a buyer's or a seller's market?
Depends on the property. I think it depends on the property. I think if it's, I've got open houses. I have people, 5, 6, 7 people attending open houses. If you market the property correctly, that individual property would be a seller's property. That's not a buyer's market, is it? If there's 5, 6, 7 people there bidding against each other, it's the sort of stock that would have stagnated. That's the different sort of scenario. You've got a stagnant property on the market. Well, why can't you make an offer on it? So it does vary on the property that's marketed. In terms of forecasting where we're going to be, I'd like to keep a steady sort of scenario with pricing. I'd like to see it sort of stagnate, if I'm honest, not going down, not going up. We spoke off air in regards to central London prices potentially dropping by £250,000. It's something that's going to ricochet out, or has already ricocheted out. What I've seen and what I felt, COVID was inflated artificially. I felt like cheap money inflated the prices and made them spiral. Everyone was bidding against each other, and I felt that was kind of the bubble. And I feel like now they were saying 10, 15% increases over that period. I think we've kind of crept back down to where we was pre-COVID. And I'm happy with that, because I felt like that was the artificial scenario. Everybody had money because nobody was spending anything.
Yeah.
I'd like to see sort of a consistent pricing element moving forward.
As Lucy alluded to earlier, I mean, it's very difficult to judge, isn't it? I mean, as people, we all kind of want to bring it on as far as house inflation is concerned, because it gives us a feeling of security and equity in our home, and always something that we can cash out and take a profit on it in a tax-free manner as well.
Yeah.
But inflation in housing is quite damaging to the economy when it suddenly stops and people go into reverse, especially, as you mentioned, at times when things are so expensive, things around us are so expensive. And it's easy to forget when it's all right when the government say, well, inflation is down to 2, 3, 4%, whatever it is. that doesn't mean prices are coming down. It just means they're not going up quite so quickly. So it's quite a difficult balance to achieve, isn't it?
Yeah, it really is.
I get some buyers coming to me on when they're bidding and offering and whatnot, because the news and the publications state that yes, it might be a buyer's market out there. Coming to me and saying, well, why can't they accept it? It's a buyer's market at the moment, and using that as kind of leverage. But it's not uniform. It doesn't work on every individual property. Sometimes you dangle the carrot of a price to get the interest in it.
But it's all about what you're going to buy next, isn't it? Really?
Absolutely.
Also depends on the seller's circumstances, right? If you've got somebody in a distressed situation that really needs to move, but how many offers do you need to make? And you have to be fairly unemotional in terms of what you're offering on. Whereas if you've just found a property that you really love and you want it, maybe there's a few other people that feel the same way about it. Whereas if you're like, it just needs to be a 3-bedroom house in this area that I draw a circle around, and then you can bid on as many as you want until you find that seller that is really motivated because they've got to go, they've got a deadline. It's, you know, they're moving out the country, their kids moving to a new school or something like that. Is quite different to just offering on someone's house and expecting them to effectively give away the equity that they think they have in their home.
Yeah, precisely. Yeah, but even sort of further on that, the buy-to-lets, that's a buyer's market. It's not a seller's market at this moment.
I do always feel whenever I've sold anything and an agent's come to me and said, well, why don't you reduce the price or whatever? The quickest test is to say to the agent, well, okay, just show me what else I can buy for the price you're suggesting I sell.
Yeah.
And that'll give you a good balance of whether they're right or wrong or leading you up the garden path or whatever agents do. Not with them having a go, Glenn. Anyway, that's all we've got time for in this half of the show. So join me again after the break when I'll be asking Lucy and Glenn more of your questions. Hello and welcome back to part 2 of Property Question Time. Lucy, how do the panel think that AI will change property finance over the next decade?
Do you know, I think you're in one camp or the other on that, and there is no doubt going to be lots of change around processing, how mortgage lenders take your application from start to finish and the speed at which they can transact that using AI, and obviously then the number of people that they need in that chain to do the work. So I think that's an absolute given, and I expect that the mainstream end of the market will see the biggest change, because if it's straightforward and it doesn't touch the sides, you know, the AI's bots can do what they need to do, and you don't necessarily need as many people sitting there checking documents and things. That's a thing of the past. These systems check documents better than humans. So it's undoubtable that will see a big shift. I think the question comes in a bit more around advice and how AI will shape advice, especially when it's something that's more unique or specialist, because there are scenarios which, certainly to my mind, and you know, I'm not somebody who is completely embroiled in the world of AI, so it could be partly my own bias, but I don't feel that AI can replace the human when it comes to the level of understanding of what someone's trying to achieve and the creative solutions that might need to be applied to that. So when it comes to advice, I'm just not sure that the robot can replace the human, albeit there are plenty of people out there that say absolutely it can and it will. So it could be my ignorance around AI that sort of limits that view.
I suppose AI could be quite capable of producing some quite interesting sort of stress test limits and suggestions, couldn't it? You know, it could create various scenarios for the underwriter to look at.
Of course, it could check bank statements, it can put it into affordability models, it can check pay slips, it can make sure everything aligns. So from an affordability perspective, what might take a human a couple of hours to read across all the bank statement transactions and then plug it into an affordability calculator, check it against pay slips and then against their affordability model, that can be done like that using AI. And you know, lenders are already investing in that, and brokerages too, to an extent, albeit mortgage brokers are probably behind lenders in terms of how they are bringing it into their businesses, but it's certainly coming. We see it. There's certain things that we're doing to help speed up the process to improve the customer journey, but not anything near how we give advice and how we make recommendations to customers. It's very much at the moment around processing, but I think it's going to change most industries, really. I
suppose one of the questions here is you have at the moment, you have somebody who wants to take a mortgage. The general advice is go to a broker, because a broker will present it in a better way to the ultimate lender than you could yourself. Mm-hmm. Do you think that AI will take out that middle part of the broker and make the lender again more directly involved with the borrower?
Potentially on an aggregator type system. So I think the reason why people go to brokers is not just to put the information together, but it's also if you go to Bank A and you present all the information, they might say, absolutely, Stephen, you can have a mortgage and this is the price that you'll pay for it. But you didn't know that Bank B actually had a better product for your circumstances, and Bank A isn't going to tell you that you should check with Bank B.
Sure.
So what the mortgage broker does is they look at the whole market and they tell you what the most appropriate solution is for your needs and circumstances, and they make a recommendation. Now, if you're putting it through a system that has all of the banks plugged into it, maybe that is a world.
It's down to who develops that at that point, though, isn't it? That's the thing.
That's it.
Who has access to it?
And what the commercial bias is, and whether the regulator would be happy that that individual is putting all of their information in and getting advice or sort of quasi-advice from a machine and not a person. I'm not sure. I'm not sure if it goes that far or not. I think there'll be versions of, but like I say, I think the world of AI is much bigger than those who are not completely educated on AI really understands.
Anything to say on that, Glenn?
Absolutely, yeah. I think it's already sort of transferred on a micro level, the onboarding of tenants. Mm-hmm. So same sort of thing, referencing it's almost as strict as mortgage applications, if I'm honest. You've got to get bank statements, pay slips, previous landlord references, credit checks, all of the above on that front. What it's done for us and me is on a fraud prevention basis. So within a click of a button, you're able to check, okay, well, this person's put this landlord as their previous landlord. Mm-hmm. Straight away, push the button, you can check on land registry that if that's the landlord of that property. Because years gone by, I used to be able to put a telephone number for any hooray Harry. Mm-hmm. Yeah, he was brilliant paying his mortgage or paying his rent. Mm. That now has gone by the wayside. Documents, pay slips and bank statements. Used to get all the time. Used to get fraudulent documents all the time passed through. Now, within a press of a button, you can check, all right, there's a snag there that means that's not correct.
And it can be very hard for the human eye to spot that. And you know, in my years doing this, I've come across it from time to time. And when you see it, you can see how many people would not spot the inconsistency. Sometimes it's that the math is wrong to a penny balance, or something, and that AI will spot that in more scenarios than a human being would.
Absolutely. Or if they've paid the correct amount of tax for their tax code on their pay slips. Yeah. That sort of situation that a human eye go, okay, bing, 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 whereas AI is picking those things up and able within 10 seconds of surfing the whole internet for it.
Okay, good. Well, let's move on. Glenn, can the panel explain why some agents consistently overvalue properties only to suggest a price reduction shortly after being instructed?
Don't smile at
on
me.
His face. He enjoyed us.
Have you heard about me? No, I'm joking. No, absolutely.
Come on, let's hear this one.
I've got to be honest. So, can you repeat the question one more time for me?
No.
On the basis of why agents do it, there can be situations where you have to portray that you're able to deal with someone's biggest asset. So if you're a cold start and you've got no properties and I'm coming to your house and I come round and I say, I'm going to sell your property for the maximum amount of money in the minimum amount of time, expose it to the whole market, but I've got no portfolio behind me showing you what I've done previously or what I've currently got on the market or what I've sold, you're not going to get the instruction if I'm honest. So what people tend to do is if they're an upstart, it does continue on, but if you're an upstart, you'll try and take on a lot of properties, and it doesn't matter what price you've got them on for, because you've got a portfolio behind you if you check on the internet and whatnot. Where you have a business plan though that overprices to get you signed up for 12-week contracts with certain corporate companies that I've been told not to mention. Or not even corporate companies, but some corporate companies in particular. The problem comes where it's a business plan to take the property on to beat the other agents and then work the price down over weeks and weeks and weeks. You're not servicing, you're not marketing, you're almost conning someone into a contract with you and hoping that you can negotiate with them to get the price down. That's what the problem is.
I think as well that it's very easy to win people over when you tell them what they want to hear, right? And everyone thinks their property is the best property in the roads, and it's worth more because of X, Y, and Z. They pull up that something sold 6 years ago for that, and you're like, well, that became irrelevant about 5.5 years ago. So it's not an easy one, is it? Because you're battling integrity versus trying to drive the business forward, and those integrity wins overall ultimately, doesn't it?
There's two other sort of scenarios that work around that though, in terms of it's so nice when you get that phone call back in 6 weeks or 12 weeks time when the agent hasn't sold it. It's so annoying at the time that you've lost out on pricing, and you question yourself. You're like, well, have I actually priced this incorrectly? But in 6 to 12 weeks time, that landlord or vendor is on the back foot, because they're coming to you going, you was right, like I take your word on board. The other situation that happens with these agents is if you have a full stock list on the market of all these properties that are stagnant on the market, you've paid £3,000, £5,000, sometimes £1,000 for the marketing. Photos, videography to get that property on the market. So you'll have, I know of a firm who you know of as well, but no names mentioned, their whole portfolio has to take £1,500 up front just for marketing off a landlord or a vendor. Because if you've got 190 properties on the market and you've done £1,500 in marketing, you've got that sitting there and you're not able to sell any of it.
Yeah, I mean, I do know quite a big firm that tells its young negotiators that if you haven't got it on the books, you can't sell it. So get it on the books at any price. At any price, and we'll deal with the legitimacy of that price later on. You know, and to a point, you can see the logic there. If you haven't got it to sell, you can't sell it.
And by the way, it's exactly the same in the world of finance. We come up against that all the time, where somebody has. They put a set of terms and they say, well, another broker's quoted me this, and you're looking at going, you just can't get that. That doesn't work. And then you get a call back in 3 months to say, we got led down the garden path. And the only thing is, and you'll probably have the same, sometimes they still win the mandate because even though they don't achieve what they told them they were going to do in the first place, they've got them on. They're so like for you, they're so far into it, especially if they've paid that money up front. So they'll stick with them, they'll sell it with that agent anyway, and you lost it just by doing the right thing, which is a challenge, isn't it? Precisely, exactly that. Yeah, it's I don't think it's ever going to end, if I'm honest with you. I think you've got a mixture as well. You've got a lot of vendors that still believe that their property's worth what it was before the interest rate started going up and whatnot. Okay, well, there we are. Thank you both very much indeed. That's the end of the show. So thank you to Lucy Waters, Managing Director of Aria Finance, and Glenn Jacobs, Director of Next Home. Thank you both very much for coming in. I'm Stephen Galpin. Join me again next time on Property Question Time.